Well, welcome back to the class on energy finance. I believe this is the fifth lecture, okay, in this series of lectures in this class. And let's see what we have done so far to recapitulate what has transpired and then continue from there forward. Last time, the lecture was mostly talking about public company, how to form a public company. For that, you have to go to the Securities and Exchange Commission. You remember all the good stories. And that's a government body, it's a regulatory body, and we have to go to Washington, D.C. And then we had a discussion, a civics lesson. Why do we have governments? Many reasons, but I look at it from first and foremost is to provide a security, internal and external. External, for which we have the Defense Department with the Army, Marines, Air Force, and the Navy. And then with internal, we have the police to protect the people walking the street and not be mugged. Okay, in that context, I said, the reason we go to Washington, D.C. with the prospectus, which is a CV, a resume, which tells the SEC, the government branch, why should they allow you to approach the public? They don't know you. That's the point. In the case of a private company, they know you. They're your friend, they're your uncle, your brother, your neighbor, and so that you're a good guy or a good young lady who wants to start business. But here you can put an ad in the paper and say, this is the name of my company. Would you like my shares? Anybody can put an ad and make it look nice and attractive for the potential shareholders, and not knowing that company may not really exist. It might be just on paper, and somebody who's ignorant may just seeing the ad may go and buy the shares and find out and that it's a bogus company, doesn't even exist. Or it's a very small company that has no future for, so to speak. So that's the role of the government, to come, ask you to come there to DC, Washington, with the prospectus, so they check it out, check you out. What are your qualifications? Why should they allow you to approach the public at large? A very good reason is for them to check it out, meaning look at your experience, look at your education, look at how many funds you have, how many people could help you in developing the geological field that you say you have, and so on and so forth, okay? So having said that, then they'll approve you. It's well, okay, if you're a good guy and you meet the requirement of proving to them that you're a legitimate person or a company. So this is done, fine. Now you have our permission, the SEC's permission to launch, start a company. Launch, start means the same thing. Again, I'm trying to use different words to explain the same thing. Okay, launch and start, no different. Once you have a company, in this case, a public company, and as I jokingly say, you're a geologist out of West Texas. And I am one, so I'm not insulting any geologist. I'm an engineer also, and I'm an economist also, and I teach banking and finance, and now I'm teaching. Heaven's sake, the breadth of what I teach and have done in life is amazing. I sometimes wonder myself, how in the world did I cover all of this stuff? But God has been kind to me. And that's all now has happened. It's in the past. Today we're talking about the energy finance part, okay, of my background. So as a geologist, you're very good in finding and looking for oil. And if you want to start a company, what you need also is the capital, the money part. And you go to where the money is, which typically would be, as an example, the New York area. That's where you have the three-piece investment bankers helping you arrange the money for you, okay? And you meet or go to one of these investment bankers or stockbrokers or underwriters, whatever you want to call them, and sign a contract. The contract is for what? For them to assist you to raise the money. That's all. And contract or agreement, same thing, between you and the underwriter is called underwriting. Simple as that. And now you have a company, you have an agreement with these fellows, the underwriters, and to raise funds. And how do they get you to, how do they help you? Well, they take your approval from the SEC and they go to the security. No, I take it back, to the stock exchange. And the stock exchange, as I said, is open to the members who are like a country club, as I said, and they become members. And last time I checked, I think it was $3 or $4 million to become a member. So like a country club, only the member of the stock exchange can trade or use the stock exchange, and primarily to use to buy and sell stocks and bonds. Fair enough. And so that's a trading forum, a place where you can trade. And you can have an account with, in my case, it's Charles Schwab, the stockbroker. It can be American Express. There are many stockbrokers. You can have one with them, and then you tell them to buy your stock from, and they're members of the exchange, stock exchange, and they will type in your request, and they'll buy you 10 shares of Chevron, Lexus, whatever you've desired. Yeah, you placed already maybe $10,000 with them to exercise that purchase. Okay, or they can give you a password for your account and tell you how to use the password, how to use the account and the password to do it yourself. In any case, they will ask you for a commission, a fee to render this service. And I have no problem with that. It's a small amount, not a very large amount. It's a few dollars, depending on the amount of the number of the shares and amount involved. But it's not that bad a deal that I would shudder too much about it. I mean, be inconvenienced because it's a big check I have to write. No, it's not. I don't think it. I've not had that experience of being charged a tremendous amount of commission. Okay. And again, the process I said to you, which I skipped, I'm just talking off the mind here, that the underwriter would ask you to sign one of the two kinds of contracts before they launch that initial public offering, public to sell to the public through the stock exchange. One of them is called firm commitment, that they will guarantee to you that your stocks will sell and that you will have a certain amount of money that you ask for. And if they can't sell it, they'll buy the stock themselves, whatever is left. The other way to do the contract is to have what they call a best efforts, where they don't commit that they will sell the stock, but they only commit that they will try their very best, called the best efforts contract. And of course, if it doesn't sell as many as that you wanted to have and to start a company, then whoever has bought your shares and paid for them, you return their money and say, well, I'm sorry, didn't get enough capital, so we're not going to launch the company. We may do it at another time, and so on. So this is all I think that we talked besides going into before, then we went into limited partnerships. And I made up a little story about you going to the country club for a dinner and all that. Still make it a little interesting. Otherwise, finance course can be pretty dull and boring. I didn't want that to happen. Okay. So having said that, the bigger you have a choice with the many investment possibilities you have where you can put your money. And here is another one, a limited partnership. And if you want to buy shares, you can buy shares in a company, oil company, pharmaceutical, agriculture, car manufacturing, whatever company sector of the industry you want to buy shares in. Or another way to invest might be to go to this limited partnership rule where you become a limited partner, not a shareholder. And the benefit of that, which I explained to the board, which was very obvious, so simple and clear, is that you save yourself from paying a lot of taxes. If you go the corporate route, you end up paying double taxes. And then if you go the limited partnership route, you pay them once. And I showed that on the board because the partnership by law, by regulation rather, are not required to pay taxes. They're a corporation before they give you back the dividends or the profits sharing, the corporation has to pay the taxes. Okay, so there's a difference there. And then we moved on to the subject of borrowing. Capital structure is made up of debt and equity borrowing. Borrowing, I said, could be referred to as a debt, loan financing, or leveraging, all meaning borrowing. Okay, now let's talk about borrowing now. What about it? In the case of borrowing, the first thought was it good or bad to borrow? And there are many reasons. Let's say it's good, other reasons that I say they're bad. And I gave you just one example of many people who become very rich by borrowing, and those who can become very poor and lose everything by borrowing. So borrowing can be both good and bad. And I explained to you that buying a house in Houston, depending on which year you bought that house, okay? So that's up to you what to borrow or not, but my job is to open your mind to the good and the bad about borrowing, okay? Now that you have borrowed the money, I just didn't have much time left. It's quite the end of the day. I just said the short-term and long-term secured and unsecured loans and so on, fully secured and negative pledge. Remember, collateral, security, and debt service. These are the things that I left on the board. Debt service is made up of principal plus interest. Okay? So that's where we are. To go from there, where we left off, now the subject is secured or unsecured, okay? A secured loan is one that has got security, meaning what? Security or collateral. Remember the word collateral? It should be with you. I wrote it yesterday to get you to start have those words in your mind, security or collateral, okay? Anything of value is a collateral or serve as a security for the loan. If I wanted to borrow for, let's say for any amount of money, and anything that is a collateral would be anything that the bank thinks they can sell and get back enough money that they can use to pay back the loan that if you can't sell, okay, anything, whatever comes to your mind, they can take that asset and they can go and sell it readily in a short time. In case you can't pay the loan back, they'll use that money, the asset's value, the sale price to recover their loan. So that's called the secured loan, okay? Simple. Anything of value that they can sell. That's called security, secured loan. I've written here on the board a fully secured loan. A loan that is fully secured. Now, listen to this carefully, simple. If the value of the collateral or the security, same thing, is more than the value of the loan amount, then the loan is called fully secured. I repeat, if the value of the security is more than the amount of the loan, that loan is considered fully secured. Example, if I own this house, it's my house, and it's valued at $300,000, then that's the value you can sell it for. And I go to the bank and I say to the bank, please, I want to use this house as a security, as a collateral for the loan, and I want to borrow only $200,000. That means the loan amount is $200,000. The value of the house that is security for the loan is $300,000. So the value of the house is in excess of, is more than the amount of the loan. That kind of a loan will be referred to as a fully secured loan. Okay, I'll slow down so you can write all this. Okay. If you want to, I'll read it again. So I'll say it again so you can read what you've written and it's correct. If the value of the security, the house is more than the amount of the loan, then that loan will be considered fully secured. Okay. Now let me explain what unsecured loan. Unsecured loan is just what it says. It has no security underlying the loan. There's no collateral underlying the loan. Now, who would get an unsecured loan from the bank? Most people, the bank would require, in most cases, to have a collateral or security before they give you the loan. But in some special cases, they may give you the loan which is not secured by any collateral, any asset. Now, I'll give you an example. Exxon, Chevron, Shell, BP, and Total may end up getting a $5 million loan from the bank without any security or collateral. Why did I name these companies? Because these companies have been in existence for 80, 90, 100 years. They've always returned the loan that they borrowed in 100 years from the bank repeatedly and returned them on time and the whole amount. So the bank was comfortable that these companies have all performed very well in the past, and we can trust them that they will continue to do so in the future. Another reason could be that they have a variety of businesses in the sense of they're in the refinery business, they're in the coal mining business maybe, and they might be in the electric utility business, as some of them are. They can be gas or refinery or pipeline business, so they're all kinds of businesses. Very broad business portfolio. So they feel comfortable. The bank says, well, we know these guys. They've been around for so long and they've always behaved nicely. We will let them have $5 million without asking for a security. Okay? So if you want to write it down, unsecured loan is where there is no security or collateral required by the bank. Now let us proceed. What is a negative pledge? Pledge is an English word meaning promise, commitment. Okay, what is a negative pledge? In some cases, the bank might say, it's only in case of unsecured loan I'm talking about, a negative pledge. In some instances, the bank will say or may say that we know you have assets worth $5 million. We know you have it, but we don't want you to use that. We don't want you to pledge that to us. We don't want you to, we will not use those assets of $5 million as security for the loan. And we will call that loan unsecured because there is no security in this $5 million case. Because you've been a good borrower in the past. So no need for presenting a security here. But there's a big but, very important but. But please make sure, borrower, that you do not use those $5 million assets to go to another bank and use that $5 million assets to get a secured loan from the other bank. Simple, nothing complicated. I'll repeat. The bank says, we know you have $5 million assets, building or whatever you have. We'll give you an unsecured loan. We don't want that building to be used as a lien, L-I-E-N. Lien is where they're part owned. Well, let's say it's security, okay, security. Make it simple, otherwise it gets complicated. So we don't want this loan to be secured by any $5 million asset, but that'll be the answer. But make sure, Mr. So-and-so, that we ask you to pledge, to promise that you will not use the $5 million as a security for a loan from another bank. Don't do that. So that will be referred to as a negative pledge, promise not to do something. Okay? Now that should be clear. I'm making it so clear. I hope you are appreciating what I'm doing. Simple question. Where you borrow money from the bank? It's all about borrowing and debt that we have moved into now. From the equity, we into borrowing and debt and all the good stuff. When you borrow money from the bank, question, do you have to return the money to the bank? Yes, you do. No doubt about it. If you borrow $1,000 from the bank, do you have to return $1,000? Yes, you do. Plus, you have to pay interest on the $1,000 for as long as you have not paid back the loan. So you got to pay the principal amount back. The loan amount is called principal amount. Loan amount is called principal with a P-R-I-N-C-I-P-A-L. I'm going to write it down. You have to return the principal, the loan amount, called principal amount. In addition to that, you have to pay the interest to the bank, whatever you've agreed with the bank. So that is called paying back the loan, repayment of the loan. Repayment of the loan is called paying back the loan. Is done through the process of what is called paying the principal interest back. And the word we use is debt service. Let's write down the debt service. Debt service means you're paying back the loan, that is the principal amount. That is the loan amount you're going to pay back over a period of time, plus the interest on that loan amount that you took out or that you borrowed. That is called debt service. That's if you want engineers love formula. DS debt service is a P plus I. Wow, now engineers are happy. Dr. Malik knows how to put a formula. Okay. Now, you sit down with the bank when you borrow money. So, Mr. Banker, we will return this loan in 5 years. Give it to us today. The loan amount is $2,000. That amount is called principal. So the principal will be here. You have to return $2,000 in 5 years. And every year, however you develop the repayments plan, every 6 months, every year, you have to pay the interest on the amount that of the outstanding balance. If you, after 1 year from whatever amount I said, you borrowed 5,000. If you pay interest on 5,000 next year, if you paid back $1,000, that means the amount left for you to as principal against you is 4,000. You pay interest 4,000. So it's on the outstanding loan. The remaining outstanding here means the remaining loan amount. That's on which you pay the interest. So this process, debt service to principal of interest is laid down when you borrowed. And then we talk about what happens if you don't follow what you laid down and agreed to it with the bank. That's a different story. So that's the point. You develop a schedule, and that schedule is a process over a period of 5 years. How you can return it is called the repayment of the loan, or also called repayment. Or also called amortization of the loan. The process of returning the loan can be called amortizing the loan, amortization, or it could be called repayment of the loan. Okay. I like to write big, large, so that it is no problem for you to read all this. The result is then I have to keep on wiping the board, and I get the wiper here, some liquid stuff, and I use that, and then that gets dirty, like here, very quickly. You see this? One wipe. Then I have to go get some more of this paper. My biggest budget is trying to get the paper, I know, paper towel to use here. I use them by large amount. Paper towel. And then I have to be careful because I just noticed this part I'm wiping now has not dried up yet from the previous case. So I have to be very careful. So let's go forward. Debt service is made up of principal interest. That brings up the question to talk about interest. Most people don't realize there are different kinds of interest rates that the bank charges, different kinds of interest rates. I will give you some names. Prime rate. So let's take up these 4 different kinds of interest rates. Most people are not familiar with them. So let me clear that first. Prime rate, there are different kinds. Is one kind. Floating rate is another kind, also referred to as a Fed rate. Discount rate is a Fed rate, floating rate, and LIBOR. London Interbank Offered Rate. First of all, every time I said the word rate, I'm always referring to the interest rate. So I didn't write the word interest every time. So if you want to write a prime interest rate, discount interest rate, and so on. Again, what is the prime rate? If it was an in-person class, I'd have 5 students, you tell me, and they'll do some guessing. This is what I think. And again, there'll be a discussion. There'll be back and forth, 10 minutes, 15 minutes, just that. Discount rate, again, same thing. What do you think is discount rate? Then go back and forth, and there's a learning and exchange. Another 10. Now I'm going to do it 1 minute on prime rate, 1 minute discount. So a 15, 18 minutes lecture in class can be reduced to 3 minutes here in online. Again, I want to say this class, in terms of time, is very condensed in a short period, which I would take much longer. If it was in person, for reasons I keep citing. So do not underestimate what goes on in a couple of hours lecture of mine, or a little more than that, whatever, depending on how many hours spent or minutes I spent talking about the subject. So far, I'm doing what I had promised to do. Develop the language of the subject of finance by defining terms used in finance. Same way as PVT is the language of petroleum engineers. Now I hope you understand why it is important to understand the language of finance. If you go to the bank, he says the prime rate is there. So what in the world is that? Dr. Malik never taught me what is the prime rate. That's why it's going to be a very practical course, folks. Very real life prime rate, getting to the point. You can write it down. Prime interest rate, or the prime rate is the interest rate that the bank charges its best customer. Prime rate is the interest rate the bank charges its best customer. What do you mean by best customer? Exxon, again, great. Always takes money, gives it back to the bank in time, on time. Experience with the bank, 50 years, no problem. Diversified business. They're the best customer the bank loves to have. So they will offer them an attractive rate, obviously. And that rate is called the prime rate. But then they say, well, another customer walks in, a regular guy. He said, Mr. Banker, I want to borrow some money. And they have not met them before, or this fellow. And then so they talk to him and they look at his what his businesses are and what is the risk involved. And has it been a good credit rating? And we'll talk about credit rating in a little while. And basically, the new fellow they're walking in, the bank is assessing the risk of not getting the money back if they give it to him. So in that case, to cover the risk, the bank might say, we will charge you prime plus 1%. That means if the prime rate is 9, we will ask you to pay an interest rate of 10%. That one extra percentage point is to compensate, to make up for the risk of dealing with this new guy. And it could go up. If the new guy looks really raunchy guy, they may say prime plus 1.5 or 2%. So the extra of the prime is a reflection of the risk that the bank envisions in this borrower's case. There's no secret about the prime rate in the bank. It's public information. You can walk in and ask the bank, what's the prime rate? And they'll tell you. Prime rate. Does it fluctuate? Yes, it does. On many factors. Simple. The price of what you buy in the marketplace, vegetable or fruit, does it change? Does it go up and down over a period of time? There's a surplus of potatoes, the price goes down. When there's a shortage of potatoes, the price goes up. Market phenomenon, as simple as economics 101, that's basic economics. Same thing with prime rate. The banks are there to lend money. That's their business. That's how they make money, is by lending money. So they're anxious to lend money. They're keen to lend money only to the good customer, the best customer, not not the less than good customer, crazy guys. They want to lend money. So there's a lot of competition One bank wants the good guy, the other bank wants the same good guy to come to them, because they've dealt with this guy and they've always been nice and gave the money back with interest. So they have to compete. Company A, Exxon wants to give to Company A the loan so they'll get back and make interest and get money from the interest and become rich. And Chevron and Shell. So there are so many if there are few borrowers, Shell and lots of bank wants to lend to them because they're good. So what would happen in the market? The interest rate the prime rate will go down to attract them. They'll say, oh, you Chevron, you come here, we'll charge you 7%. And Shell will charge you 8% or the other way, 6%. So it's like, and vice versa. If the 10 borrowers, only 3 banks down the street who are willing to lend to you, then the prime rate will go up. It's a supply and demand, nothing magical than basic supply and demand. Now, there's another factor that can influence the prime rate. That is called the discount rate. So what is the discount rate? It sometimes refers to the Fed rate, Fed meaning for federal bank rate. We have a federal bank. Every nation has a federal bank. The president of the bank, or the chairman rather, is appointed by the president of the United States. Only very recently, President Biden reappointed the chairman, reappointed. He was there as chairman, so his tenure period of stay there as chairman had ended. The president could put anybody in his place or anybody new, or he could say, well, you continue, fellow. You're doing a good job. President Biden extended the chairman's tenure. It's a very powerful position to be chairman. So I'll talk about why is it so powerful. So the Fed rate, or the federal government rate, and now let me define it for, is the interest rate. Because the Federal Reserve Bank, you may have heard of the Federal Reserve Bank, the government bank. The interest rate that the Federal Reserve Bank charges other commercial banks, not you and I. You and I can't go to the federal bank to borrow money. Big commercial banks can go there. So Federal Reserve Bank lends money to other commercial banks, like Bank of America, Morgan Stanley, or JP Morgan, whatever they are, Citibank. No. The rate that the federal bank will charge other commercial banks like Citibank to lend them money. Sometimes the bank wants to borrow like $500 million from the Federal Reserve because they need it for maybe a few weeks. They may have overextended themselves, promised a lot of loans, and now they want to have some money to lend and say, oh, Mr. Federal Bank, give us some money as a loan and we'll return it just for 3 weeks. So that federal rate that they will charge other commercial bank is called the discount rate, or the Federal Reserve Bank rate. It's from federal bank on to the other commercial bank. So if the federal bank rate goes up, the other commercial bank, when they borrow from, their rate would go up. When a businessman comes to borrow from the commercial bank, they have to pay interest rate which is higher than normally would have been. When the interest rate goes up, what happens? the business goes down, because that's how it is. If you want to, so the federal bank affects the interest rate all the way into the borrower in the street, the businessman. And if the interest rate goes up, you got a big problem. This is an unusual time. I don't know if in my lifetime I will ever see the interest rate as it is today, 1%, 2%, 3%. When I bought my house in 1981, President Carter, oh yeah, I think that he was the president. The interest rate I paid on that was unthinkable, was 17%. Now it's 1%, 2%, 3%, 4%. So the point here is that the federal bank can make a big difference to what the interest rate goes on in various banks, or they ask for interest rate. And therefore, federal chairman, and they have board of governors, like the board of directors of the federal bank is very powerful, the chairman, particularly Mr. Powell. There's another reason. There's one position I know of that the president does appoint the chairman of the board of the Federal Reserve Bank, but he cannot fire him. He's independent of the president's wills. So there could be a Republican president who can appoint a Republican chairman, and the president gets defeated in the next election, but the Federal Reserve chairman stays on when the Democrat is there also. So he goes beyond the election, or not the election of the presidency. So the president has to be on his good side so that the federal bank does not increase the interest rate, and therefore causing the commercial bank rate to go up, and then the business people have a problem running their business and would suffer a loss. So you see the point? Let's talk about the next category, is a floating interest rate. Floating means what? Floating. What else can I say? Floats up and down. Floating, you ever been on a boat? Up and down, depending on the waves. Now, I cannot imagine any bank today giving you a loan for 10 years or more, which is at a fixed interest rate. Mortgages are a different story. We won't get into those. I'm talking about businesses. And those are totally different stories. Mortgage is when you borrow for the house, and there's insurance and all the other good stuff. But let's give up commercial loans for business to run your business. How can they give you a fixed interest rate for 10 years when they don't know what it will cost them to borrow from somewhere else to give you the money? If they borrow, okay, let me explain a little bit how it works. When the bank says, we'll give you $2 million loan, agrees, accepts. Does it mean when you leave the bank office, they start going home, or in the bank, they have a minting machine, they start printing $2 million? No. They have to get $2 million from somewhere to give it to you. Now, where do they get that from? Many places. One of them is capital markets, money centers like in Shanghai or in Hong Kong or New York or London or Paris. How does a person, business selling shoes or mangoes make a profit? Simple. Again, a discussion if I were in the class, 10 minutes on that. Very simple. The only way a fellow selling mangoes or potatoes or shoes, there's only one. They buy at a lower price or cost, you can call it, and sell it for a higher price. The difference is the profit. In banking, we call it difference of margin, M-A-R-G-I-N. Margin means profit. How do they end up buying at a low price? Or how does a businessman ends up buying shoes for $30 at a low and sells it to you for $40? Making a profit. Only one way. There's nothing magical about it. They buy wholesale. They may buy 300 pairs wholesale, and they get a special discount on the price of shoes because they're buying in bulk. And then you walk in and you're buying retail. You're buying one pair of shoes. So they charge you $40 for that. Nothing wrong with it. Happens every day. Every time you go to the shop, he bought bulk at a low price, he sells it to you at a high price, and there's nothing. That's how they make money there. You like the shoe, you pay $40. Similarly, banks go to capital markets around the globe, the big ones, and borrow money wholesale, large amounts of money, billions of dollars, and negotiate a lower interest rate, and then you come in as a retail borrower, individual, and they give it to you at a higher interest rate. The difference in the interest rate they pay and you get it, or you pay, is the margin. So let's say that. So now going back to where I started off. Do we know? Does anybody know? Does anybody have the wisdom of Solomon, the prophet I keep talking about? To say that how much interest will they have to pay after 10 years to get the wholesale amount? Nobody knows. Interest rates fluctuate on many factors. So therefore, no bank can afford to say, we will give you this rate, at, the interest rate will be 10% on the loan, because for 10 years, they can't, because they may end up borrowing themselves after 10 years at 12%. How can they commit now to give it to you at 10%? When, because they'll be losing money every time. So they don't want to take a risk. I don't blame them. So what do they say? They say, no, for long-term loans, let's have a floating rate. Up and down, float. Float with respect to what? Float with respect to prime interest rate. If the prime rate goes up, the interest rate they will charge you will go up. The price come down, the interest rate they'll charge you comes down. So they're saying, we will go up and down, float, the interest rate will be floated depending on many factors. One of them is the prime rate. Nothing wrong with that. So they will say, is a floating rate is 7% if you want to borrow, plus 2%. 2% is the fluctuation. P plus 2%. The prime rate is 7%, plus 2 is, to compensate the fluctuation. So the prime rate goes up, if it's 7, so we'll charge you 9, 7 plus 2. If prime rate goes down to 3% plus 1, we'll charge you 4%. So they tie it to the prime rate and add something to it, like 1 or 2 or 3%, depending on circumstances, business environment. Therefore, they're floating there. There's no risk involved there, or very little. There's always risk. Later in the lecture, we'll talk about, after still to finish, the other one is LIBOR in a minute. We'll talk about, are the bankers conservative? Yes or no? Are the oil people looking for oil? Are they conservative? Yes or no? Why are the banks this way and the oil people are this way? We'll talk about that. What's inherent in the oil business, what is inherent in the bank business. It's all, bank is finance, finance is bank. So that's why when we talk about finance, we're talking about banking. And I was a banker for a while. I mentioned that in my resume to you. Now the question is, what, Dr. Malik, is LIBOR? We're getting to the end. LIBOR stands for London Interbank Offered Rate. London Interbank Offered Rate. What does that mean? Sometimes banks, again, they rely on each other, they borrow from each other, the banks borrow between banks, called intra-bank loan. Intra, I mean I-N-T-R-A. Between banks. No. Intra is within, inter is across. When you refer to something intra, that is inside, within, inter is across banks, different banks. I'll explain in a minute. Banks sometimes say, well, we have trying to, or we have committed to lend so much money. That's $200 million. At the moment, we don't have $200 million to lend immediately. So let's go to the next door bank that are friends of ours. We are X, they're Y. Let X go to Y and say, Mr. Y, please lend us $200 million for a week or 2 weeks. So the bank Y chooses to lend bank X $2 million or whatever, 2 million or 200, more like a 200 million. So the interest rate that bank Y will charge bank A to lend the money is called interbank between Y and X. Bank Y is the bank, bank X is the bank. So the interest between banks, interbank, within bank, between, not within, is called LIBOR. Okay? Very good. Now let's see what is next in my things to talk about here. We're almost 1 hour into the lecture. And we're moving on to yet another subject about banking, And this will, it's a commercial bank loan agreement. It's agreement between bank, with the borrower and the bank. So this is going to, this that I'm flashing will be part of, would be an attachment with today's lecture. So when you're listening to the lecture now, at this stage of an agreement between banker and bank and between the lender and the borrower, the bank and the borrower, please have this attachment in front of you so that I'll cover this. And when I'm covering it, talking to you, you can have it and you can follow exactly what I'm saying. Okay, like this, just exactly what I'm saying. That way we can cover a lot more because you will have the attachment in front of you. Okay. Having said that, it's an hour into the program and you need a little break. So let's take a little break too, because it's interestingly, it's a different kind of a subject now. And it's a logical time. I don't take a break just for the heck of taking a break. Sometimes I feel like we're going this far, but this is a logical time because we are moving to another kind of a subject. So why not take the break? So the break, the thinking, so we start fresh with the new thinking. Okay. So I look at those opportunities when is appropriate time to take a little break. So having said that, let's take a 12-minute break. Oh yeah, okay, yeah. Let's take a 12-minute break, and I'll come back. and we'll start again. And this is what you should have in front of me when I come, okay? Thank you very much. Well, welcome back. I'm back, of course, on time. So before leaving, as I said, we're going to start a new chapter. And the chapter is written on the board, loan agreement. Agreement between whom? Between the borrower and the lender, lender in this case, the bank. Okay? Whoever is borrowing is the borrower and the bank is the lender. So borrow money from the bank, and there has to be a contract, an agreement, same thing, both agreement, contract, of how much money and when will you give it back and the interest rate and all the stuff, and the warranties and the covenants and so on. So please, I'm going to educate you, may take half an hour, may take 45 minutes, to what are the various clauses, what is contained in the agreement between the borrower and the lender, lender at the bank. So next time when you go to borrow for a house or anything else, or your car, you know what to expect. They will make you sign an agreement. And so if you look at this attachment and work with me and follow me, you will have no problem understanding what I'm talking about. On the top, it says commercial bank loans, and there are several lines. It says commercial bank loans are the most important sources of debt for project financing or any financing. They may take the form of secured, unsecured loans. We already talked about that. They may be in the form of a construction loan. Now, if you're constructing something, a big building, you may want a loan for that. So there will be documentation between the borrower and the lender, what kind of documents will be required by both sides and what would be signed by both sides. So documentation for commercial bank loans consists of many things. One is the loan agreement, which I'm going to cover right now. Promissory note, the promises you're going to make in the agreement. I will do this, I will do that, I will do this. What kind of guarantee and security you have? What if you're offering a secured loan, or if you're asking for a secured loan, or if the bank is asking for secured loan, and you want to have some lien or security for the loan to present to the bank, then what are those documents? And there are a few other things that you may ask. So now you know what the bank is going to require from you before they write the check as a loan to you. So let's do it slowly. And I continue now. Some of the key points to be covered in a loan agreement include what is in the loan agreement. Of course, a thick document, or maybe it's not that thick, but 7, 8, 10 pages. And again, depending on the amount of the loan and what you need it for, it could be much thicker. Okay. Let's start with number one item. As you can read in the agreement, this is the loan agreement. What it contains is the loan amount which may be borrowed. Doesn't need much explaining. For heaven's sake, I don't have to spend half an hour explaining that. The bank in the agreement, you can write, I want to borrow $10 million. That's all. Now, the one is commitment fees for unused amounts under the commitment. Most people don't understand who are not bankers, they have no idea what is a commitment fee. And they're very surprised when I explain to them what is a commitment fee. Now let's do it. Let me give you an example. It's an interesting example. You might find it a little interesting, a little funny even. Some, not quite funny, interesting maybe. You go to the bank, and you say, Mr. Banker, you're the borrower. Okay, when I say you, I'm talking of you as a borrower. And I'm the banker. Okay, you come to me, Dr. Malik, call me the banker. Forget I'm not a professor at the University of Texas. And you go to the bank and you meet me and say, Mr. Banker, with Dr. Malik, Mr. Banker, I'm Mr. Banker, no professor. We want to borrow $10 million. I said, very nice. Why should we give it to you? Well, they'll present the case that we have these assets and we want to use this as security and for the loan. And then I say, I look at those assets, and in my case, when I worked at the bank, the assets were always presented as oil and gas reserves under the ground, in the ground 10,000 feet, 5,000 feet below the surface. From that, my responsibility was to ascertain or determine the value of that oil in the ground starting today. How much is it worth in the next 10, 15 years? And what is the present value of that today? What is coming in 15 years? What is the value of that today? That would be my recommendation. This is the loan value today. Whether the bank will give them that or not is another point. But this is what the value today. It could be wrong. It could be right. I have no clue what the value would be in the future. Now, so I say to you, I'm the banker, yes, Mr. Borrower, I will be happy to give you the loan of $10 million. And of course, you're very excited. No doubt about it. Meaning, the borrower is excited. And he says, oh, thank you very much. Let me go and tell my engineers that we have a loan agreement that the bank will give us a $10 million loan, and we can get started on the project. And the engineer is very happy too. So when you're and the establish an interest rate, of course. So when I say, yes, we'll give you the loan, and you're ready to run out of the bank to tell the good news to the engineer, I might ask you, the banker, no, Mr. Borrower, have a seat, please. And you sit down, and the banker says, write me. After you sit down the second time, listen carefully. You will not believe what you're going to hear. That's the interesting part. The banker, I'm the banker, will say to you, the borrower, write me, the bank, a check of, let's say you want to borrow $1 million, and 1% of $1 million is how much? Is $10,000, I guess, yeah. So I'll tell the bank, if I want to borrow $1 million, I keep forgetting what amount I established, but that's $1 million. So I will tell the bank to write me a check for $10,000. There's 1%, let's say, of the loan. My goodness, have you heard what I said? Why did you go to the bank? The reason the borrower went to the bank is because they want to borrow the money of $1 million. Instead of borrowing money, they're giving money to the bank of $10,000. Isn't that unusual? Very unusual, unheard of. You're going to the bank to get the money. Instead, you're giving money to the bank. Let it sink in. People, when I talk to them, say, how is that possible, man? This is what happens. And I'm going to repeat so that you say, don't think I'm making a mistake. Instead of getting the money, the borrower is ending up giving the money to the bank. The question is, excuse me. Let me get something to write. The question is, why am I, the borrower, giving the money? No, sometimes I say I'm the banker. Why is the borrower giving the money to the banker? Whatever I am, don't worry about it. Because it gets confusing. Because the bank gave the borrower something. What? What did the bank give? Did the bank give him $1 million? No. What is the something the bank gave to the borrower? And for that, the bank says, give me $10,000. Yes, the bank gave the borrower a promise called a commitment that when you need the money, whenever, we will have the money available to you. We will give it to you whenever you want it. You don't want all of it now. Maybe after 3 months, you may want money, and so on and so on. And for that promise, they made a commitment. For that commitment, not yet given any money to the borrower, the bank charges what a commitment fee is. Generally, it is a small percent of the total amount of the commitment. In this case, $1 million was the commitment they'll give to the borrower when needed. And for that, they may charge maybe a percent, which comes to $10,000 or so. Just a commitment, a promise to make the promise, okay? Called the commitment fee. Next line. Number 3 is, in the agreement, you have a term of the loan and repayment schedule. How long is this loan for? Is it 6 years, 5 years, 3 years? I don't know. You have to write it down. And how are you going to pay it back? Remember, I gave you a long story about repayment made up of debt and service and interest. So they establish every 6 months, every 3 months, every year, whatever is agreed to by both sides, we will be giving them a debt service made up of principal and interest till the entire loan is paid off. So it is clearly laid down. So you have to follow that schedule. You can't change. We'll talk about What will happen if you change that schedule or don't live up to that schedule? We'll talk about it. Number 4, common sense. There will be an agreement on the interest rate the bank will charge. Whatever it is, they agree to. Number 5, I'll do it slowly because this needs a little explaining. The procedure for takedowns and conditions that are precedent for the takedown. Okay. So we have to establish first and clarify, what do we mean by takedown, right? And what procedure are we talking about? Takedown is like this. Okay. Let us say you're into a drilling venture. You want the money for drilling, okay? And you say, well, we want $10 million for drilling this well. After we've done, first of all, give us $1 million. That's it. We'll take out $1 million from the total that you're committed to 10 million when we start the exploration or when we complete the exploration. Okay. That's it. That means you've taken down the loan. That means you've taken loan of $1 million. Then you lay down in the agreement that after we have established we should drill, we will do the first well. So when we do the spudding and the first well is drilled, we'll ask for another $3 million, okay? Or maybe more, maybe $4 million. So 1 million when we do the exploration, 4 million for drilling. Okay, so now we have 5 million outstanding. Outstanding means standing out as a loan to us, the borrower. So now when we place the casing in the well, that time we will ask for another $3 million. So there's 5 plus 3, 8 million is the outstanding loan. And so on, when we do some logging, or when we do this thing or that thing, when we do perforation, we'll ask for 10 million. So what it is, over a period of time, it is established between the borrower and the lender that certain functions, procedures, same thing, have to be evident, performed before the bank will accept and pay you the next amount that you will ask for, the next installment from the bank. They won't all of a sudden write you a $10 million check on day one. You'll have to, it's a procedure, you'll have to, and conditions precedent, so for that, so you'll establish, when I do this, give us this one. When I do this, I'll prove it to you, I've done this, you send your consultant, let him look at what I'm doing. And as we continue to do this, you start releasing the funds to us. So this is referred to as takedown, in tranches. Let's see, tranche. I can write a tranche. Let me. T as in table, R, A, N as in Nancy, C, H, E, S in tranches. Okay. Number 6. There have to be some guarantee, warranty the bank is going to ask for. For example, what are you representing? What is the warranty? Giving you 2 or 3 examples. Why do you need the more money for why are you borrowing $10 million? Tell us what are the use of proceeds right here. Meaning the amount of the loan is 10 million. Why do you need it? What's the use for that money? You have to specify clearly. If you say, I'm going to use it to build a building or drill a well, and you'll sign, please be careful. You cannot take the money and say, I changed my mind and I'm going around the world on scuba diving trips. Or going a safari to Kenya and Tanzania called the Serengeti. Buy a new car. No. You have clearly said in the agreement what you will use that money for. Simple as that. You cannot change that unless agreed to by the bank. If you don't, you will have a problem. And we'll talk about what is that problem. That means you are defaulting, that you're not living up to the agreements. And then what happens if you do not live up to the agreement? Will come on the next page. You have to give a warranty. What is the financial condition of your company? I don't know. You'll have to show us. How have you performed in the past? Have you always been running a lot of debt? Have you been meeting your financial obligations, financial condition? How much debt do you have already? You cannot lie. And if the borrower lies, this can be a serious crime. This is one way to go to the jail. Don't do it. I'm not saying you're doing it. I'm just saying it in a rhetorical way. No. Don't do that. Not there. Not on this. They make you fill up the form and all that stuff. Now, what is your condition? So on and so forth. Then they will ask you to warranty is required concerning the title to your assets. In case of a secured loan, you're pledging your security are your assets, right? If you're saying this building belongs to me, how do I know it belongs to you? The banker will ask. How do we know? They will ask for a title. And what does that mean? A title establishes ownership. I'm going to slow down to let you write all this. I'm moving too fast for you to be able to write. A title establishes ownership. Meaning what? That what I'm pledging to the bank as security belongs to me. Here is the proof, sir. Here is the ownership. For example, I hope you don't get stopped by a traffic guy going at 100 miles an hour. He comes to the car, and the first thing besides the license is going to ask you that do you have the permission from the state of Texas to drive? That's the permission. That's what you call the license. The word license means the permission to drive. Next thing they are going to do, apart from the insurance policy, do you have an insurance? It's mandatory in Texas. You cannot and will not and shall not drive legally unless you have insurance coverage to cover somebody else, at least. If you cause somebody damage to his car or his limb or his, you have to compensate him, and they want to make sure you have an insurance. This is what the police officer is going to ask. Be prepared for it. The third thing that is going to ask for how do I know you're the owner of this car? Maybe the car is stolen. These cars get stolen all the time. And the third thing you present to the police officer is to establish you own the car. It's just only on document on paper called the title. He wants to see that, and that will establish, yes, You're the legal owner of the car. In fact, when you say, I have sold my car to Mr. X, what is meant is you have transferred the title to Mr. X. Now he is the owner, and you have signed off on the title is now Mr. X's car here. I've said a lot about warranties and takedowns and all this stuff. I will pause to let you write all this. Okay. Item number 7. Legal opinions will be required at the closing of the loan agreement. No, the lawyers have to always step in and see, your lawyer and the bank's lawyer, that everything is legally correct. You will sign off and they'll sign off. At different times, first of all, when you go to the bank, say, well, we started drilling and give us $2 million per the agreement. That's a takedown. So the legal fellow will jot it all down. It's all written down. What is it? What did the agreement say with respect to takedowns? And at that time, and periodically through the agreement, the lawyer will have to be involved if there's anything not done per the agreement, according to the agreement. Let's go to number 8. Interesting one. We're going to talk about covenants. Number 8 shows affirmative covenants. Okay, let me see. Here I can say, I make it easy for you. Affirmative covenants. First of all, let us talk about and define what do we mean by a covenant? English word. Covenant means promise. That's all. Generally, you read this word or come across this word in religious text, like the Bible, or God's covenant to his prophet. God's promise to his prophet. God's covenant. Sadly, or well, I wonder sadly, it is just strangely, bankers use the same term, covenant in the agreement. I'm referring to God promises to his prophets in the religious scriptures. They think, the banker think, they are no less than God. So in their agreement, they refer about covenants that only we hear about in spiritual text. But never mind, that's the problem. I not mind what they want to call it. But covenant are promises, very, very important, that the borrower will make to the lender. I will do this if you give me the money, loan me. I will not do this if you don't, if you lend me the money. They all lay down clearly. 1, 2, 3, I will do this, I will do this. We're going to talk about 2, maybe even 3 types of promises the bank may require from the borrower. I've yellowed it. You can read the list. Payment of taxes. The bank will say, well, Mr. Borrower, I will pay taxes on this house that you are buying, you're lending me against, on time. That's affirmative. Doing something. Yes, yes, yes. I will do that. If you lend me the money for the factory, example, I will maintain the equipment properly. That's it. Affirmative, meaning yes. If you give me the money, I'll make sure that I have the necessary government approval. Oh, yes, I will have the necessary government approval. I just talked about insurance, didn't I? Yes, I will carry an insurance all the time on this factory, house, car, whatever you want to talk about. So this, and you're every time you're going to sign, yes, 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 yes. I will do this, I will do this, I will do this. It's all but I will do it, I will do it. Okay. Turn the page. Well, then there are negative covenants. That's number 12. Okay. There could be financial, well, that's number 9. I wanted to focus more on the negative and the affirmative, but let's throw in number 9 also into the context of the conversation. Subject is covenant. There are also covenants called financial covenants related to financing and financial matters. Let's talk about at least one. Example is limitations on indebtedness. Very important. This will also constitute a negative covenant. Financial here would also blend in with negative. It'll serve as an example for both negative and financial covenant. Negative is number 12, for example. Very important. Now the negative means no. Financial covenants mean if you lend me the money, I limit myself that I will not borrow any more than this amount. I will not borrow any more. What if tomorrow there's a fantastic opportunity? You want to get into something so wonderful opportunity to get into it. And you can't. For that, if you want money, you may have to borrow money. But according to your agreement, you said, I will limit my borrowing, indebtedness. I will not borrow, so you cannot borrow, so you can't benefit from that opportunity. You limit it yourself. So these covenants are very confining, confining. They're putting you like this, left and right, straight on. Be careful when you're signing an agreement. Be very careful. In the rush of signing an agreement because you want to build a house, we ignore all of this. There's a fine print there. You're ready to sign so that you can get into the new house from borrowed money. They can really, really be very confining. Take away their flexibility. Number 10, responsibility of any withholding tax on the interest. Not on anything, doesn't have to, just withholding tax is enough. In certain cases, not always, the banks withhold the tax from the borrower's account and send it to the IRS, the tax department, Internal Revenue Service of the U.S. government. That's on or behalf of the borrower, ahead of time, maybe a year. So the borrower says, we're going to take out some money of free profits and make sure we send it to the tax department so they say you are paying taxes, because if you don't, and at the end of the year, you spent all the money, all the profits, and comes time to pay the taxes, you have no money left to pay taxes, you're going to have a very serious problem, the US government. Very serious problem with the US government if you do not pay taxes. So the bank doesn't want to be confirmed, can be facing this kind of situation. So they say, well, to make sure you're paying taxes and that you will have a running business, and from running business, you'll give us the money back and the loan, the whole thing. We will be sure to keep some money back to pay your taxes, so you will not be caught in a very strange, awkward dilemma of not paying taxes, and then the company goes bankrupt because the government took over and we will not get our money back. Some banks may want you to say, okay, you can take out the taxes. The bank doesn't keep it. It's not their money. They keep it so they can give it on your behalf to the government of the United States, called Internal Revenue Service. Number 11 is interesting. Read it yourself first. Let's read it together. Number 11, enforceability of the rights of the lender. Read it carefully, very important. In the event of a default, I'll explain that. And remedies in case of a default. If you default, what are the remedies? The bank wants to know that. Now I'm going to explain all that. Enforceability of the rights of the lender in event of a default. The word default in banking terms generally means, remember you have an agreement that you'll pay back the loan in certain time periods. It's a promise you made. What if you don't keep the promise? What if you said the money will be coming to you in January the 15th? It does not to the bank. You're in default. What does it mean? That means you did not live up to your promise, and what remedy can there be? It says here, event of a default is that if you did not pay what was due on 15th of January, you are in default, and you lay down, what can the bank do to you now? This is all part of the agreement. You agree when you borrow the money. They say, if you say, the borrower says, if I don't pay back the money, boy, this is the remedy. This is what you can do. Remedy in case of my not paying the amount that is due in January. One of the remedies is the bank says they will reserve the right to pull a trigger. They will reserve the right to pull a trigger. Let's write down the word trigger. Okay. English word trigger. Very simple explanation. If you are a hunter and you carry a gun, and if you have a gun, what is it? The trigger. You put the trigger, and out goes the bullet. And if there's a deer or any animals up there, you're aiming at it, and it's good aim. And you pull the trigger, and the bullet goes and hits him. What happens to that animal and the deer? It's dead. It's dead. Because you pull the trigger, and the bullet killed the animal. That's exactly the word the bank uses. That if you are in default of the agreement, we reserve, they may or may not, but they do have the right, reserving that we may or may not do it, but we do have the right that if you like, we will pull the trigger. What does that mean? Banking term, the question is, what does a trigger mean and imply? The trigger means, in banking, that we have the right now to call the loan. The word is call the loan. Write it, call the loan. That means we, the bank, have, if you've been defaulting, have the right to say call the loan. Means if you borrow $10 million, We want you to pay the $10 million right now back to the bank. Right now. That means the bank has called the loan because you were in default of the agreement. So what happens? How in the world are you going to pay $10 million to the bank? Possible, not possible. You cannot go and borrow money from another bank. If you think that's what you might do, no, you can't. If this bank where you borrowed, you already defaulted to the loan, what makes you believe that the next door bank where you're going to go and ask for more loan ever going to let you into the bank? Don't imagine that. This is not how it works. So now you can say, well, Mr. Banker, sorry, you don't have the money. So now the bank has a choice. They can, if they like, and they sometimes do, go to the judge and say to the judge, Mr. Judge, here is the agreement. And here it said that we will pay the bank in a certain time, and they are not doing it, and they are in default. Therefore, we, the bank, should take over the operations of the company. Please, bank, tell the management of this company to leave the offices, give us the key so we can enter and run this business ourselves. Now, that's what happens. You're out of luck, you're out of business. The business now belongs to the bank. All because why? You signed a covenant and you did not live up to it. That's what it means. It's part of the agreement, you signed it. Finally, negative covenant number 12. I've already explained them. Negative means I will not do something if you give me the loan. No, no, no. Affirmative is an English word meaning yes, yes, yes. One could be, give me an example. Mr. Banker, you'll write it, it's signed. Can't default on that. You're going to have a problem if you do. Listen to the bank. When you signed up to signing, you do something different. Mr. Banker, please, negative. You lend me the money, $5 million, or let's say $1 million. I'll sign that I will not sell this property. Will not do something. Meaning what? Negative covenant. Or you can say, Mr. Banker, I may sell the property and whatever money I receive will be used to pay back the loan first. Most banks will agree to that. So that means, and then if you say, well, I will not sell the property, you do, you've got a big problem. Again, that's in default. The trigger gets pulled, and then there goes the calling of the loan. And what follows, I just explained to you. Let's talk about a certain kind of loan called a syndicate bank loan. Syndicate is the word. Let me write down so you get used to the word syndicate. Syndicate bank loan. Now, if you were taking my course on Fridays, called the International Petroleum Agreements, I will talk a lot about joint ventures, farm in and farm out, and so on. We're almost there in the course where next time or the time after next time, I'll be talking about farm in and farm out and joint ventures. So I'm going to run a parallel between joint venture, which we think of in the terms of oil projects, and run a parallel to what we think of a joint venture in terms of a bank. The only difference is in what we call joint ventures in the context of an oil business, exactly parallels is what we call a syndicate bank loan. What we call joint ventures, all in the banking world, we call it a syndicate bank loan. These days, the oil business, projects are going farther into the sea. We have to drill deeper to look for oil. Most of the easy to find oil has been discovered. We have to go to remote areas. What I'm really saying is that the newer projects in oil and gas exploration production are getting to be very, very expensive. I could relate to one project that I've heard about several years back. It was called Mukluk, M-U-K. L-U-K, Mukluk project. It was in Alaska. You're not going to believe some of the numbers I'm going to give you. The Mukluk project in Alaska was called Mukluk 25 years back. Why do I have to talk about it? You know the cost of the project then, not today, was $1.3 billion with a B. And that is $1,300 million. That is one and then 9 zeros if it is a billion. Wow, huge project, one of the biggest in the oil business at that time. Now, why do we talk about it? Today it would have been a $2 billion project because of inflation, maybe. And guess what? After spending that kind of money, mostly it was to build an artificial island and all. That was a dry hole. I don't think it's a mukluk, it's a bad luck. $1,300 million dry hole. The question is, how do companies survive such a debacle? Disaster. Only because most projects, including this one, are joint ventures with not 1, 2, 3, 4 companies together. The biggest, I think we were talking about it yesterday. I hope I'm not repeating it here. One of the biggest oil fields discovered in the last 25, 30 years is in Kazakhstan, a country that is 6 times the size of France. I may have talked about it before. The field that is, I'm talking about, the biggest in the world in the last many years is called Kashagan. That's the name of the field. K-A-S-H-G-A-N. So why do we talk about that? Because that was not one, but there was a multi-billion-dollar project, one of the biggest oil projects ever in the history of oil. And everybody and his friend, the Exxon's and the BP was in it, came out, Total and Eni, the Italian. All the big companies in the world were in that project and still are as joint venture partners to spread the risk. So when you go to the bank and you say, Mr. Banker, I want $500 million loan for this energy or petroleum project or refinery, if you want to call it. No single bank wants to take on $500 million risk. They will, the insurance company do the same. They will say that they'll probably bring 5 banks with them and say, each one takes $100 million or puts $100 million together cumulatively. We will have $500 million to give to the borrower. So we have spread the risk, just like a joint venture in the oil business. This, in banking terms, while we call it joint venture, is referred to as a syndicate bank loan. Now let's talk a little bit about joint ventures and syndicate bank loan, only to spread the risk for large projects. In joint ventures, part of my agreements course, we have what is called a farm in and farm out of companies in the venture. If a company decides to leave the venture project, if it's they may have a 30-year agreement to stay in the project with the government of Australia, and after 5 years they may decide to leave. They may leave provided they bring somebody in their place with the approval of the government of Australia. That's a condition attached with it. Now, the company that is leaving to go to Australia is said to be a farm out company. They're farming out part of the oil ventures all the time. Please learn about oil ventures here now. The company that is coming into the venture could be BP from wherever in London, is farming into the project, coming into the project. If the government of Australia agrees to this arrangement and they have no problem, then that's a done deal. Similarly, in case of syndicate bank loan, there could be 5 banks going into the project, each putting up some amount of money. And after a while, after maybe 2 years, one bank says, well, we really want to put money in another project, so we have to take this money out of this project to put it somewhere else. For whatever reason, we're not getting into reason why they want to move. So they can farm out, leave the project, provided they bring somebody else in their place. So it's a parallel to a joint venture. Okay? So there's a syndicate bank loan. A syndicate bank loan, let us say if it was consisting of 5 banks, Could be necessary because if you've got different currencies involved, you may have a German bank. Well, now it's the same currency like a euro. You have a German bank which brings in the euro currency, and you may have a Norwegian bank we bring in the kroner, with a Japanese bank bring in a yen, and a US bank bring in the dollar, and the UK bank bring in pound sterling. So you got 5 different currencies, 5 different banks bringing in their currency into the picture if that becomes necessary. So that's also possible, the reason why you have a syndicate. But primarily, they're done with projects which require a lot of loan, okay? That's the main reason for having it, is syndicate bank loan, okay? Let me take this off. Bonds. So I'm not debating with myself, bonds, B-O-N-D, whether to continue now when you're exhausted or start fresh. When I talk about bonds, I want this to continue. There are 10 parts, maybe 12 parts to, or 10 maybe definitely, to what is a bond, how do you pay it back, what is bond rating, and how do you retire a bond, how do you redeem a bond, how the credit bond rating, and so on, debentures and indentures of bonds. So I rather not touch 3 aspects of bonds and finish it with 7 more next time. That would not be interesting and not be useful, I think. I rather start bonds next time and continue and cover all 10 at the same time in the one lecture, so you get the complete story about bond, because it's a very, very important subject you ought to know. You have shares and you have bond. I've talked a lot about shares, but I haven't talked anything about bonds. So allow me, please, now, for a logical reason, that we take a break now, go home and rest yourself. So next time it comes, the subject will be bonds, and you will be enlightened with what is a bond. Then you can decide whether you want to be a shareholder in a company or a bondholder. What is the difference between a shareholder and a bondholder? What is the role of a shareholder and the role of bondholder? What's the difference between interest rate and a bond rate? You see, I'm already telling you there's so many different things to discuss about bonds. I'd rather do it all at one time so you get a good picture of what is a bond. Having said that, have a good evening, good night, or good morning, wherever you are. Catch you next time. Thank you very much, and bye-bye.